Hello, this is today's SCORE webinar and on Behind the Learning Curve. And I presume uh, you all are signed up for it because you have great interest in borrowing or want to know how the process goes. We're very fortunate today to have an extremely experienced uh, banker, and I'll introduce him in a few minutes. As soon as we get a few more people signed in. Uh, and give you a few minutes on SCORE up front, and then introduce Dave, and he'll present his webinar. Well, why don't we get started with the SCORE presentation? Uh, for those who are new to SCORE, you've probably seen these slides. If you're not, just a short introduction. SCORE is the largest network of free volunteer small business mentors in the nation. No matter what stage your business is, SCORE has a mentor for you. And I'd also add that if your business is a nonprofit, we're also mentoring nonprofits. We're one of the few organizations that will do that. It's very easy to request a mentor to help you. Just go to our website and request a mentor, put in your zip code. Our mission is to foster small business communities through mentoring and education, such as these webinars. We aim to give every person the support they need to thrive as a small business owner. You're all aware that small business drives our economy, and they're critical to vibrant communities in our society. In northeastern Ohio, both SCORE and the SBDs are very active, and we are very successful in improving the small business environment. We're volunteers. We give freely our time, energy, and knowledge to help others. A little bit of impact nationwide last year. SCORE created over 150,000 jobs nationally, and over 30,000 new businesses started. And it's very important to note that SCORE is for all. 65% of our clients are women. Almost 50% are minorities, and somewhere around 10% are veterans. So we are very proud that we're able to reach everybody. And again, all of our services are without cost. One thing that's important to note is that we have a very rigid code of ethics that we protect our clients. We are not permitted to make money in any way from SCORE clients. We may not use your information or database for any commercial reasons. All client information is confidential and protected by the U.S. government. And it's worthwhile to know that if you do work with SCORE, and if you receive 3 or more hours of mentoring, it's been proven that your success is much greater than not having a SCORE mentor. And I do want to comment again that our services are free, and that SBA, Small Business Association, supports us, and along with a number of other generous sponsors, including Comstar Credit Union. And we're able to, as a result of that, we're able to deliver our services at no cost. Now, if you are looking for a mentor or want to volunteer, please go to our website at www.score.org, and be great to have you check in with us. Okay, I'm going to stop this sharing and turn it over to Dave Chizewski. Dave is over 22 years in banking in the nonprofit banking sector. He will explain a little bit of his background, but we are pleased. He has been providing webinars and working with our clients for several years, and it's a great relationship. He is in Lorain County with the head office in Elyria, I believe. Correct.
That's right. That's right. Thank you very much. And welcome everybody to part one of Behind the Lending Curtain. I appreciate the gracious intro. My name is Dave. I'm the CEO here at Comstar. We're celebrating our 88th year of not-for-profit banking in the credit union space. And it's been a great relationship with Comstar and SCORE, and helping teach a little bit of this mystery of what happens when small business owners send in a loan application packet and want to get to yes, right? That's always my goal here, and all my team would tell you that that's one of my sayings is when they ask me questions, how do we get to yes for the members? So this is an overview of what lenders are going to consider when you submit your business loan packet. And you're probably not going to have an answer tomorrow. I know a lot of people like to have things instantly. Most business lending doesn't happen that way, and I'm going to go over why. Just a couple housekeeping items. If I'll give you time at the end, as long as you need. If you have questions in the chat, Bob can take a look at those. If not, I do have my contact information here on the next page. DaveJ@comstar.org. Just feel free to send me an email, and if I don't get it to you either today in part one, please come back for part two, and I'll answer those questions, or I'll take those offline and answer them after the sessions are over. Like I said, I enjoy helping teach this class for SCORE and SBDC, Boots to Business for veterans. I do a lot of strategic planning facilitation. At one time, a small business owner, and just, some fun facts that we're all humans too, not just, banker sometimes gets maybe gets a rough nod on occasion, but, I like to do through hiking in the national parks. It's kind of a passion of mine, and not a great banjo player, but, I give it my best. So let's get started. Thanks for joining. So in the next two sessions, like I said, most financial institutions they might not do everything in the exact same sequence that we're going to talk about, but for the most part, it's very consistent that most of the things we're going to talk about, you're going to run into when you send in a loan request. And so we need to focus on a few areas to make it as successful as possible. We're going to talk about the matrix, not the one with Keanu Reeves. We're going to talk about risk barrels, how to get risk barrels empty and how risk barrels get full. We're going to talk about the structure of loans and commitments. And then, some players in the approval denial process. There's a committee typically, and there's also somebody that I lovingly call the dream killer, which is otherwise known as underwriting. And then what happens and what can you do if you get a yes for now, or if you get a no or a no for now, how to kind of attack those scenarios to get to funding. And then once we get to funding, we're going to talk about life after funding. So typically this particular session can go 3 and 4 sessions long. We've condensed it down to 2 to get into this lunchtime slot. But like I said, if you have any questions, please, DaveJ@comstar.org, or put them in the chat. But we'll get them answered.
Dave, I failed to say that the slides will be forwarded to the participants, and it is recorded and will be available on both our website and our YouTube channel.
Awesome. A lot of times, if I talk too fast, some people might be like, oh, I wanted to ask about that. So anytime you reach out, if you want to watch the recording again, or if you just want to reach out, we'll, to Bob or myself, just feel free. We'll get you the answer. Okay. So kind of in the beginning, there was a decision about the banking relationship, right? The relationship between you as the business owner and the bank. And a lot of times what I see happening with small business is small business owners, they do personal banking, right? And so if that financial institution has commercial loan or commercial services, sometimes that's just a natural, hey, look, I'm going to start my own business, or I've started my own business. Can I do the same? So one thing that I will say about the banking relationship is not every business and not every financial institution is a good fit. So there's typically three categories, right? There's big corporate banks, people like Ford Motor Company deal with that kind of thing. That's not us. There's regional banking, and some of that regional banking, like you see like the Huntingtons of the world, that kind of thing. And then there's another category. There's kind of community banking and credit unions. Credit unions are the not-for-profit version of community banks, which are focused typically regionally, or even smaller, even by county level. So those particular institutions have different structures for how they do commercial banking. You just need to know which ones are a good fit for you, for your needs. SCORE and SBDC, help in packaging. I'll tell you a story. When I was a business owner, I was looking for a little bit of capital for some expansion. And I went to a business banker, put in my application, and I got a denial, right? And not, if I would have known some really good resources like SCORE, SBDC to help package loan requests early and use those free resources, I think that it would have cost me a lot less heartache of going through the denial process. Well, what don't I have? What do I need? All this kind of thing. And so please reach out to those folks. And then documents. Yes, financial institutions need a ton of documents, and every single loan, business loan, is unique. Everyone, I've never seen two the same ever. And so they'll ask for documents based on the complexity of the deal. And then SBA, we're talking about how the SBA supports SCORE, and SBA has a fantastic set of business loan platforms to help financial institutions approve loans. And so just when you think that you've submitted enough documents, if you go the SBA route for an SBA guarantee, there will be even more documents. So please be patient with your loan officer. They would appreciate it. And just know that sometimes they don't get all the documents right off the bat. So some quick things to remember. Yes, you will be asked to be personally responsible and credit bureau reportable for business loans. If you have an LLC or however, that may shield you from some responsibility for liability. There may be some tax benefits, but from a lending standpoint, you are going to be responsible as the principal or owner of that business. So break even. A lot of people, when I first talk to them, we kind of go over their business plan, their pro forma, and they show break even, and they're always surprised when I say break even is 25 cents short. So when you are working with whoever that's going to help you package a loan request, or if you have some accounting folks that you're going to talk to about it, just keep in mind that most lenders like to see that for every dollar that is going out in expense, you're not just making $1 back. Okay, so that would be break even, but $1.25 back for every dollar out is a good ratio of what they're going to be looking for. So just keep that in mind when you're putting together some pro formas. We appreciate the idea that you have the first money in is yours and the last money out is yours. We like to see passion and for the business, and willing to take the risk of your own capital, and love paying my taxes. This is inevitably where I get a ton of questions. So let me just explain what I mean by this. I understand that opening a business and how you formulate it and how you categorize assets and that kind of thing, there are some tax strategies involved there to reduce your taxable liability, your tax liability. I get it. I want to pay the least amount of taxes as possible. However, if you continue to show on tax returns, even if you would say, well, these are paper losses, that your business loses money, loses money, loses money, loses money year after year, that's not a great trend for lenders to look at. So between your lender and you and your accountant, if you have one, you should understand the ratios of how much tax do I need to pay to show the lender that, yes, this company is viable, it is making some money. I understand that there may be some tax liability implications with that strategy. I'm just trying to help you understand that some lenders don't like seeing just loss after loss after loss after loss after loss with just the argument that, well, those are just paper losses, those kinds of things. Along that vein, one of the things that I think is a good piece of advice is to talk to whoever is doing your accounting. And if that's you, great. And if it's someone else, great. And understand DSCR. So DSCR is debt service coverage ratio. And what that is kind of this idea of not only is it the difference between break even and that 25-cent short that we were talking about, but it's all the other things involved, your other debts that you have leveraged, and sometimes in your personal side of the house, you've got debts there, and all of those things come down to this debt service coverage ratios. There's a couple different types, transactional and also global, which take into consideration many things, but you should have a good understanding of what those ratios are and how they're calculated, because your lender is definitely going to look at those to see if you're a responsible borrower. Also, there's very few instances where we see these kind of, well, I don't know what I would call them, angel investors, I guess is a term that you hear, where it's kind of like, hey, I'm going to give you this money, I don't want anything for it, I don't want to be an owner, just, good luck to you, kind of thing. That typically doesn't happen very often. So people who usually put some money into a small business have some type of expectation for performance or return. And if they are in at 20%, then we would consider them a principal or an owner. And so they would also be responsible for any lending activity or request that you have. Lenders are not investors. So, we look at a request and we look at what's good for the borrower and what's good for the financial institution, and try and put something together where we can both get to yes. But one thing we don't do is we don't say, hey, look, you're actually doing better, so we want you to pay us more. So we're not on the investor side of the house. And yes, the other side of that coin is true too. If you do worse, you still have an obligation for your loan. So sometimes people talk to me, and there's just kind of this idea of more community banks and credit unions maybe have a different attitude about it, but we are not on the investor side of the house. Transparency builds trust. I'll tell you, this one of my favorite stories. One of my very first loans I did, I had met with a gentleman that owned a business who was in business for a long time, but I didn't know anything about him or his business. And he gave me a business plan and a pro forma over what would have been the life of the loan. And for the first year, he showed, typical revenues and profits. And then all of a sudden, for next 3 years, he showed negative income. And not a little bit, substantial. And then coming back in the fourth year. And I asked him, I said, well, tell me a little bit about why this is in here. And he said, hey, just to let you know that I know that in this city, they're going to be doing a road project starting next year. And that road project is going to go right in front of my business. And I think that that's going to impact my business by that much. And so what I really appreciated about that is I hadn't gotten to the due diligence point of knowing that the city was going to do that in front of his business. And he had the forethought already of, hey, look, I know this is not normal for my business. This is going to impact my business. And yet he put that right out front for me. So that kind of transparency and that kind of conversations really build a lot of trust between a lender. Like, you understand your business and you understand things are going to impact your business, and you're willing to say that things aren't going to look good, but this is why I'm still a good risk. So just keep that in mind. Okay. So the three-legged stool, like I said, most financial institutions will have basically these three things, not necessarily called the same, not necessarily do things in the same order, but you're going to have a loan officer. So the loan officer is who you're most going to directly deal with about putting together a loan presentation. And you hear it's the 5 C's and all this kind of thing. And yes, that's true. So that's between you and the loan officer. You're going to talk about mutually beneficial structures, what you're looking for in a loan and what they're looking for as a lender. It should be mutually beneficial. One of the things that does get frustrating for loan officers is they feel like there's not the mutual benefit. There's kind of this expectation for it to be benefit, maybe a little lopsided. And so sometimes those conversations are tough to get past. The term of the loan protects the lender from market volatility, and the amortization of the loan protects the borrower's cash flow. Okay. So most business loan terms are going to be 5-year. Well, let's say I have to ask for $500,000. If I were to just divide that by 5 plus the interest rate, that term is going to be good for the lender, because if things happen in the market, Federal Reserve, who knows, rates go up, rates go down, that kind of thing, it kind of protects the lender. But it's no good for the borrower, because the borrower probably say, well, I can't operate this business and make enough money as I'm growing this business to pay that based on divided by 5 years. So a lot of times business loans will do an amortization schedule. So I might say, okay, I'm going to take a 5-year term, but I'm going to kind of look at that loan as if that loan was a 20-year term. All right. And so all of a sudden, my obligation is divided by the 20-year. All right. So that helps cash flow for the borrower. The borrower has the greater ability to repay the loan. And then in 5 years, or whatever your renew schedule is, you take a look at it again. So that's what I mean by mutual benefit. Okay. And then what other conditions to offer? Sometimes the loan officer may ask for certain things to take to the second leg of the stool, which is this business loan committee. And then they're also going to do this kind of rough matrix score of risk. There are different categories of risk. We've got a huge spreadsheet that has all these categories of risk, and the loan officer that you deal with should start putting things into these categories. For example, one of the categories is, well, how long have they been in business? All right. If you've never been in business, this is a startup, it might be 1 score. If you've been in a business 20 years, okay, that business for a long time. That's a different risk source. So there's a bunch of categories. Different financial institutions have different categories. And then the loan officer is really the advocate for the borrower approval, right? So typically the borrower is not going to talk to the business loan committee. That's going to be the business banker or the loan officer. And what happens is that committee, that might be just at the branch or just in the regional area, they're going to review that package. They're going to evaluate all those risk profiles, and then they're going to also evaluate the financial institution's concentration position. So let's say, for example, there was a bank out there that decided 3 or 4 years ago they really wanted to buy a lot of investment real estate, right? We want to lend to people who have investment real estate. And they did hundreds and hundreds of those loans. And let's say they've got, you know, $5-10 million into their loan portfolio of just investment real estate. Well, that financial institution might say, hey, look, I can't take on more investment real estate loans because I have too much concentration in that one area. So I can look at pizza shops or I can look at snow plows, that kind of thing, but I might take a harder look because I have so much in this one category that I kind of like to spread out my risk. So that's on the financial institution side. So they will evaluate that. And then also, what is the best scenario, conventional or SBA? Conventional loans, they have all different shapes and sizes, and SBA also has some great guarantee portions. We're going to talk about that a little bit later today. But they're going to decide what is the best situation for mutual benefit. And then, is this going to be an in-house loan or a participation loan? So to borrowers, participation loans are pretty transparent. If I come to my local Comstar office, I make my payment, I pay it online, great. But what might be happening in the background is, let's say, for example, you needed $1 million and you wanted to buy, well, let's just keep on with this example of investment real estate. But that financial institution says, well, I only have $500,000 available because I have a lot of concentration in that category. So that financial institution might look to another financial institution and say, hey, do you want to go in with me on this loan? I can only put out 500K. Can you put out 500K? Here's the borrower's profile, looks good, so on and so forth. And so now all of a sudden you might be participating, the financial institution might be participating with another lender. To you, it doesn't matter. You still get your $1 million. You're going to make one payment, that kind of thing. But those kinds of things happen in the background. And then we talked a little bit about conditions. So what conditions to offer back? Conditions can be almost anything. And sometimes they're as easy as, hey, we would feel a lot more comfortable if you were to park 3 months worth of your business loan payments in a savings account as kind of a security deposit of sorts. Oh, okay. All right. So sometimes the loan committee goes back to the loan officer and says, look, here's some conditions that we might offer to get this deal approved. And then I talked about, most stools have 3 legs. Well, here's the third one. Now, I have to laugh. When I first made the transition and I started getting into commercial banking and lending with credit unions, there was actually someone that I did some work with who used to be a commercial underwriter, and this literally was her nickname, the Dream Killer. And she's very nice lady, and does a really good job, really thorough, those kinds of things. But unfortunately, underwriting has a different view of loan packages that are sent to them, and so she kind of got this nickname, which I don't really think was warranted, but it's still kind of funny. And so I came up with this slide because I knew there was a class she was going to be attending, and I've used it ever since. And she kind of laughed because she knew I was talking about her. But underwriting is a very important part of the business loan approval process. So we're going to get to the importance of, why they exist and how to put the best foot forward with them shortly. Okay, the matrix. So there's a score. And on the right-hand side, we look at score factors that most matrices have. Some have a lot more, but this is typically kind of the baseline. So first off, debt serviceability. Can you pay the loan? All right. What credit scores are in there? And but it's not the first thing. The first thing is always the ability to service your debt. Loan to values in there. A lot of people that I talk to, sometimes they say, hey, I'm going to buy this, $100,000 pizza oven for $10,000. So, you don't have any risk, but that's not what we look at first. It is a factor. Loan to value of whatever your collateral is a factor of the score, but it isn't the most important thing. Other financial ratios, I've seen some really great software that even predict the chance of businesses going bankrupt. They actually have this kind of algorithm, I guess, that predicts that kind of thing. So sometimes FIs use other ratios in this scoring. The profitability of the business. Now, some people say, "Hey, Dave, I don't know, right? I'm buying this franchise or I'm starting this new business. I'm not sure where to get you that information." So SCORE can help you look up these things called NAICS codes. And these NAICS codes can give the lender the opportunity to say, "Oh, okay, well, I know that you sell widgets, but you've never sold widgets before, but there's a NAICS code for widgets, and I can get information for widget people in your area, and it'll show me that information so I can have an idea of how I think you're going to perform." So don't think that if you've never made a profit with your business or if you're a startup, that's an instant no-go. We can get information that give lenders good ideas as to what you're trying to accomplish. Risk barrels. Risk barrels is coming up next. It's how do we take risk out of a barrel and what fills up risk in a barrel. So all those factors really have to do with how the lender is going to evaluate your ability, and they're going to give you a score. Scores typically go 1 to 10. And most financial institutions that do loans, their loans live in the score range of 3 to 6. Typically, if you're a 1, I don't think I've ever seen a 1 loan where everything's perfect. You've got bajillion dollars. You don't even need the money. Your company, it's just, they have no debt. They have crazy amount of capital. We just don't see them. Now, if they score 8, 9, 10, most FIs are going to say that those are too much risk of loss. And so they just don't approve those. But typically, I've seen some 2s, seen lots of 3s, 4s, 5s, and 6s. That's usually where the deals live. So don't be discouraged if they, give you some kind of initial risk score 5 or 6. That doesn't mean it's a no. It's just that you have to evaluate what kind of factors gave it that score. So just like golf, lower the score, the better. And that typically leads to lower cost of borrowing and higher likelihood of approval. If you have a low risk score, typically whatever your interest rate is or your terms could be a little bit better than if you were on the 6 or 7 end of the matrix where they feel like there's a little bit more risk. So here are the barrels, right? So I'm going to show you how these get built. So on the left, we're going to show you an example of a barrel that's full of risk, and then I'm going to show you a barrel that's almost empty of risk and why lenders like the one on the right. Okay, so think about a barrel, and it's raining here today, so this is probably an easy example. And it's filling up with water, and when you get to the first line, that's your loan request, right? Like, I need $100,000, okay? And that's going to fill up a whole bunch of this bucket. And then the lender says, "Well, tell me a little bit about the collateral. Tell me a little bit about how much of your money you're going to put in." And that's the very next little sliver. Okay. Yes, you're going to put a little bit of money in. I'm buying a $10,000 pizza oven, but it's worth 12, right? So I've got a little bit of excess value there. But then when I look at my debt service coverage ratios, I do have the ability to pay. But I'm at 1 point, let's say 1.0. Remember earlier we were talking about the idea of 1 to 1, dollar for dollar is break even, dollar to $1.25 is good. So this is short of that, 1.25. This might just be of all the things I have to spend, I'm still going to make a little bit of money, but maybe it's only like 10 cents extra. All right. So, excuse me. So this is a little bit, this is a barrel that's kind of full of risk, right? If that makes sense. So on the right-hand side, this is a way better scenario for a lender. First off, you're asking for less money in loan. Okay. So there's less water in the bucket. Then after that, the amount of money you put in or the amount of value of the collateral you're going to put against the loan is a lot higher. So I'm going to, I need 100,000 on the left. Here I only need 50,000 because I'm going to put 50,000 in. Okay. So that makes up this big gap of equity. And then, I'm a pretty conservative guy. I don't drive a Ferrari. I don't party every weekend. And I'm dedicated to my business. And so I don't have a lot of debt associated with my life or my business. And so all of a sudden, my debt service, my ability to pay really stretches over the top of the barrel. Okay. So in a scenario on the right, this is probably a 2 to a 3. Okay. Risk score. The scenario on the left is like 5, 6, 7. Okay. If that makes sense. Now, we talked a little bit about the Small Business Administration and some of their loan guarantee programs. So here's what happens to these barrels if the SBA gets involved. So the shaded area of yellow is what represents the SBA guarantee. Now, remember, the SBA is not a lender. Okay. What the SBA does is they work with financial institutions, Comstar being one of them, and says, hey, we want small businesses to be successful. And I understand that they may be close to getting a denial or not quite up to certain risk standards to get a loan. So what we're going to do as the Small Business Administration is we're going to give you a guarantee against a percentage of the loan dollars. So if you look at the barrel on the left, all of a sudden that 100,000 you were asking for, SBA might say, you know what, we're going to guarantee to the financial institution that if they do that deal, $75,000 out of that 100K is going to be guaranteed by SBA. And so the risk associated with doing the loan really goes down. On the right-hand side, no different. Okay. So that risk on the right-hand side, especially since you have a much larger equity position, goes way down. Okay. Probably into the 2 category. So the power of using SBA is great from a getting it across the finish line in appropriate situations. Now, there are some trade-offs. Some SBA guaranteed loans have a little bit higher cost to do than conventional loans. Takes a little bit longer sometimes, a little bit more paperwork, a little bit more things you have to tell the government because they're going to put tax dollars basically at risk for you. But it's a very, very effective tool to reducing risk and getting a better risk score. So anytime you want to talk to a lender about what SBA programs are out there or SCORE or SBDCs, be happy to connect you with any of those folks. Now, after all that is said and done, your loan officer is going to go to underwriting with your loan request packet. Why does underwriting have to exist? I think I've been asked that question. That's a very good question. First off, underwriting is a very disinterested third party. They typically have not looked at or heard the stories or heard the histories of the borrower and the loan officer and the committee. It's a third set of eyes, and they are really just looking at lender and borrower safety. Okay. credit unions and banks have a certain amount of assets. They have a certain amount of members. They have a certain, they have a certain responsibility to keep those organizations vibrant. And on top of that, they want to make sure that the borrower understands really what they're asking for and the amount of obligation that they are going to sign for. Okay, so underwriting basically is a check and balance against the loan application and the loan committee, and asks very pointed, difficult questions sometimes without all of the story. All right, this is what you're showing me. This is what we're looking at. Here's my questions. I don't see it this way, or I do see it this way. And then there's a regulator function. Every financial institution is regulated by an entity. We're regulated by the Ohio Department of Financial Institutions, and also by American Share Insurance that protects, share deposits, those kinds of things. And so they have certain compliance procedures, processes, regulations to make sure that we are doing lending fairly and also to protect the organization. So the underwriter will look at all those standards also to make sure that those are in line. Unfortunately, the borrower sometimes feel like underwriting is kind of this good cop, bad cop routine. But remember, your banker is now your liaison, right? They're now talking to this underwriter, okay, just like they were trying to get it through the loan committee. Okay, so they're still that liaison. Underwriting really doesn't really care about how much love you have for the business. I'll give you an example. I met with a borrower once, and he called me on the phone, and he's like, "Hey, I've been working in the trucking industry, and I have this invention, and I think it's going to be huge, and I want to go to truck stops and sell it, and it's going to save truckers all this money, all this kind of thing." And I just say, "Hey, I don't really know about anything about the trucking industry, but I'd love to hear more about it." I was extremely curious more than anything. So literally he comes in and brings in his invention that he built in his garage. And I'm like, "Oh, I get it." Right? Like, now I understand and he was so passionate about it. Underwriting, I won't say that they don't care about hearing that part of the story, but it's just not their function. Okay. So sometimes they will make statements that are really frustrating to borrowers about documents that have been submitted, such as, "Well, we think that's irrelevant," or "No, you didn't give us those already," or "Yes, I know you explained it to the loan officer. Can you, let's explain it again." But one thing they do is they do have the power to say yes. So if they say yes, that's a good thing. All right. Usually when it gets to the point, it gets to underwriting, and underwriting says, "Yep, we looked at everything you told us. We agree. That looks good to go." But they can also say yes, but they might want to add a few conditions to things. We talked about conditions a little bit earlier. And then, of course, your loan officer will have to go back to you and say, "Hey, look, we're close, but here's what underwriting is asking for. And how do you feel about that?" That kind of thing. So they also have the ability, and I never like to say underwriting says no. I say underwriting says that they would not recommend funding. So that's not the same thing. Now, it's very rare, but sometimes some financial institutions, under circumstances where underwriting says, "Well, we wouldn't recommend that for funding," may fund that deal. Now, I'm not saying that that happens often, because it does not, but it's not no. Typically, if underwriting says, "Hey, we don't recommend," FIs will say, "Okay, yeah, no." All right, even though we accepted the risk, we liked it, but if it can't be underwritten, typically they won't fund it. So, but it's a not recommend, it's not a no. That's kind of how I like to classify that. So also what they do is they'll take the spreadsheet of your matrix and they'll have their matrix, and they'll kind of look at it side by side. All right. So yes, they're going to look at debt service. They're going to look at credit scores, LTV, range tolerance, right? Do we like to be in the 2 to 3, or can we live with 5s and 6s, or can we live with a 7? what is the tolerance of their range? Biz profitability history. We talked about where to get NAICS codes, all those kinds of things. Past loan performance is a huge piece. So they have looked at a lot of deals that are going to be in your industry, and they'll have a good feel for how much risk is really in there if those deals go bad. So if you have had a loan in the past, the performance that you've had on that past loan is going to hold a lot of weight, okay, with underwriting. And then also the SBA guarantee for, just looking at that example of the barrels, right? Will the SBA guarantee the loan? Okay. So once we look at the packet, the committee, and underwriting, everybody, puts all that together, then typically what happens is underwriting has a discussion with the loan officer and they go talk to the loan committee. All right. So if the committee votes yes, there's a few things that you have to consider. One, what are the conditions of the loan? Do you need to put some money away, a few payments away? Are there covenants? Now, this is very important. There's a humongous difference between conditions and covenants. A condition is, hey, I agree to do this, all right? But a covenant is, I swear I'm going to do this, or I'm going to put this loan in default, okay? That's a big difference. So you need to understand what the loan committee or your loan officer is asking for. Are they asking you for a condition, or are they telling you this is a covenant that has to be memorialized in your loan documents and will be reviewed annually? That is one thing that needs to be understood that I don't think is explained well enough in the loan application process. And then what are the costs? There's always costs, especially if you have real estate involved, go into, title fees, all those kinds of things. And then the commitment letter. One of the things that is very frustrating as a lender is sometimes we will get calls from potential borrowers and they say, hey, I've got this approval from XYZ and here's their terms. The first thing I ask for is I say, hey, congratulations, that's awesome. We would love to look at that deal. Can you show me the signed commitment letter from the financial institution? So there's a big difference between a signed commitment letter and a pre-approval. I get pre-approvals in the mail all the time. All right. But if you really have a deal from another financial institution, that financial institution will put it in a commitment letter and sign it with saying, hey, this commitment is good for X amount of days. All right. So appraisals, do we need an appraisal? Are there other underwriting factors? Are we waiting for environmental to be figured out? Are there participants? Do we have to go to another financial institution and say, hey, this deal's looking good, but we might need some help on the funding? Is that in play? And then site visits, right? We'd like to come out, take a look at the site. The loan officer probably has already done that. If not, I always invite borrowers to invite your loan officer to come out and take a look at the site so they know exactly what they're talking about, where it's going to be, where something's going to be manufactured, investment properties, those kinds of things. And then the committee can also say no for now. So, too much risk score, too much concentration risk. Maybe the borrower has a loan history with them and we don't want to put too many loan dollars for one borrower. Maybe the NAICS category or the industry, we talked about investment real estate. Maybe I have too much in there, so I just can't put as much in there. Maybe I don't have a participant right now, but I'm going to look for more. And, maybe the dollars category, that kind of thing. Reputation risk. Ohio is kind of in this new kind of marijuana, banking, lending, recreational, medicinal. They're kind of in this space right now. And that's gonna lead into that kind of banking and lending and that kind of thing. And our financial institutions say, hey, there's too much risk to our reputation. We don't want to be involved in that. All right. So some financial institutions will say no simply for those reasons. And then of course your strengths, weaknesses, collateral appraisal shortage. You want to borrow on a home, it's 100,000, but the appraiser says it's only worth 80, those kinds of things. Environmental issues. Hey, phase ones, phase twos. One of the trickiest parts about environmentals is if you go into chain of title on a business that you're buying or a property that you're buying, and you find environmental issues after the fact, then you own it, right? So there's a lot of, okay, what do we need to reclamate? There's brownfield funding. That's a whole nother conversation. And then some things might be SBA ineligible. So there's franchise language that has to be approved by SBA. There's a franchise list that the SBA has. Some franchises, there was a business called Curves, and Curves was a fitness place, but just for women. And the SBA said, no, we won't do anything that has that type of restriction on it. So there are those kinds of things you have to vet out. And then, of course, the underwriting recommendation. So dealing with that. So the committee will typically vote based on that stuff, and then go back to the loan officer to talk to you about it. Okay. I've done a lot of talking in this last 55 minutes or so. I will give you as much time as you need for Q&A. I know I threw a lot at you, and you might think of questions later. You can always email me here, davej@comstar.org, or come back for part 2 and shoot me a question, and we'll answer it in part 2. So I'll open it up for Q&A.
I'd just like to comment that tomorrow's part 2 is tomorrow, same time, noon, and you should have a link for that if you register. There is a person raise their hand. Let's see. Can't find it now.
Oh, let's see. If there is a question, throw it in the chat.
Oh, here you are. Is underwriting a condition imposed by law?
So it depends. I guess the way I would answer that is I would say that there's probably a distinction between regulating entities and law. Okay. So most underwriting that we see is a base of regulatory function. They want to see a third set of kind of disinterested eyes on a deal and make sure that your lending practices are up to what, let's say like the Ohio Revised Code, that kind of thing. That's typically, don't see where somebody says, hey, it's illegal for you to do a deal without underwriting it. That I don't see that scenario. I hope that answers your question.
Yes.
Okay, excellent.
Apparently.
Yeah.
Okay, well, I'd just like to remind everybody that it's always advisable to seek a mentor, and go to www.score.org. Just put your area code in, and be happy to assign a mentor to you. Well, here's another question. Hey,
Yep.
what about grants? Okay, you see it. Is it better to try that way first or get a loan?
So grants, I think grants are a great opportunity if you have the resources to investigate, apply, and get them, right? And sometimes people that get grants, even though there's not a repayment requirement, there may be other requirements. I saw a business owner get a partial grant, and we were going to actually loan the balance. And one of the stipulations of the grant was that they had to go through a certain accredited DEI program. This was last year. And so sometimes the grant monies are out there, But they also kind of come with conditions sometimes too. So you have to evaluate whether or not that's something that you want to go through to do. But anytime that you can get dollars to help your business and reduce the amount of debt that your business has is a plus. Okay. So, I might look at those side by side, from a timing standpoint and say, okay, this grant closes at this time, and maybe I need to see score to put a loan packet together or to try and get a loan for the balance, or if the grant falls through. So we don't have a problem looking at deals that are going through a grant program. And at the end of the day, you say, hey, look, I got my business funded 100%. Great, rock on. We hope to be able to help you with other commercial banking needs. And then if you need loans in the future, we'll talk about it then. So yeah, if you can get it, great.
What often you get, companies get grants to develop technology through various government agencies. And just remember what Dave said, you got to look at the conditions. Typically, they will reserve the right to your technology for government use. So it's always it to find, getting a grant under what condition is very, very important.
Yes. Yep. Okay, awesome. I hope everybody can join us tomorrow.
Well, here we go again.
Here we
What
go.
organization provides the business credit scores?
So, what's the most popular one? Probably Dun and Bradstreet is probably the one that pops into mind for most, as far as getting a business credit score. But I tell you, if you look under the NAICS codes, you can find a bunch of businesses under there, and you can see all that stuff. So you could evaluate where you're at compared to them.
Yeah, and the other one SCORE usually advises us, our clients, to look beyond the NASIX to the RMA, the research, manage. RMA is research. Well, it's a gathering of all the data of NASIX codes on as to their profitability and all their financials, and it's broken down throughout the country by size of companies. So it's a great way to see what typical inventory levels, profit margins, et cetera, are, and working capital requirements. And Research Management Associates, and I know it's available at the Cleveland Public Library, and ask any librarian if they could get it for you.
Yeah, that is a really good resource.
And TransUnion.
We look at Experian, TransUnion, and I can't remember the third one off the top of my head for some reason. Especially on mortgage lending on the consumer side, mostly on the consumer side, not on the commercial score side. But that's just us. Other FIs may do it different.
Mm-hmm. Oh, very good, Dave. I want to thank you for a wonderful presentation. Part 2 tomorrow, same time, same place. Uh, and hope everybody can make it, and see you tomorrow.
Sounds
Take
good.
care.
Thank you. See you tomorrow.